Recently, there was an article published on Prospect Capital that even received some mainstream media coverage. According to a Bloomberg report from last week titled "Private Credit Fund Burned by Risky Bets is Bleeding Cash," Prospect Capital has been going down a very dark path for a number of years. And today they claim that the company is exposed to an astronomical amount of risk. According to the report, it says, Prospect Capital, a little-known New York firm that helped pioneer the private credit boom, has come up with an unusual technique to keep dividends flowing out of an $8 billion fund it runs. For years now, it's sold financial instruments to retail investors and handed over the proceeds to shareholders. I've personally never been a shareholder of Prospect Capital, despite the appealing features of their stock, which includes a high monthly paying dividend. However, I do know that it's a very popular holding among income investors and BDC fans, so I wanted to give my 2 cents on the accusations in this article. The report starts off with stating that many of the companies that have borrowed from Prospect Capital have been having a significantly hard time paying them back in our high interest rate environment. As a result of this, Prospect Capital has been accepting payment in kind, or PIK arrangements. These are when the lender goes to collect the money from their debt, but the borrower doesn't have the money to pay the lender. So instead, the lender, or Prospect Capital in this case, will look at them and say, "Alright, well if you can't afford to pay us, we'll issue you new debt so that you can pay us later." As a result, the company is actually allowed to report this as income. This Bloomberg article has this little comic strip that explains what's going on at Prospect. At the lender's office, "You owe us $2 million in interest on your loan, but I don't have that cash. No problem, we'll just add that $2 million to your bill in the form of new debt. Great. It doesn't really matter if they pay us with cash or additional debt, we can still count this as income on our books." Now, what I think is definitely worth mentioning is that payment in kind isn't new to Prospect or even exclusive to this company. PIK has been around for many years, and every BDC is currently using this method to a certain degree. Even the much bigger and well-known BDCs are using PIK arrangements with some of their borrowers. Ares Capital has some PIK arrangements in their portfolio, and so does Main Street Capital, Blue Owl, and every other BDC I looked at. So doing this isn't unique to Prospect Capital. What is unique, however, is just how much of their portfolio is relying on payment in kind arrangements. A whopping 1/3 of their reported income was directly attributed to these PIK arrangements, meaning that without them, Prospect Capital's dividend and book value would be significantly lower than what they are today. To quote the article, Prospect's investments generated cash flows that were $200 million less than the amount of their fund's distribution in dividends last year, the biggest shortfall in the last 7 years, analysts say. What's more, the price investors are willing to pay for a stake in the fund, known as Prospect Capital Corporation, has plummeted to more than 40% below the value of its underlying assets. This all sounds extremely concerning for this company. Their stock has been trading at a tremendous discount, and according to closed-end fund advisors, is the second biggest discount in the BDC sector. I listened to their latest earnings call, which was back in May, and they stated on the call that their non-accrual rate was just 0.4% according to their chief operation officer. This definitely doesn't sound right to me. If 1/3 of your income came from borrowers who are needing assistance in paying Prospect, how can you report that only 0.4% of your portfolio isn't performing up to expectations? For reference, the BDC non-accrual average right now is currently 3.8%. So on paper, it appears that Prospect Capital is doing exceptionally better than average, but the overuse of PIK suggests otherwise in my opinion. Another point made in the Bloomberg article is that the company has been forced to issue a lot of preferred stocks and unsecured notes to help compensate for their mediocre portfolio. From the article, in less than 4 years, it's sold over $1.6 billion of preferred stock, which sits junior to all the fund's other borrowings. Prospect has also sold $460 million worth of unsecured notes designed for individual investors, known as baby bonds, its filings show. This appears to be uncharacteristic for this company to do. The article even goes as far to suggest that this company is relying on unsophisticated retail investors to pick up the slack for their issues by purchasing their new issuance of stock. Managers can prop up the valuations of their assets and paper over any losses with cheap debt, but it only works as long as new money keeps flowing. So overall, this article doesn't paint a good picture for this company. Based on what they're describing, Prospect Capital sounds like a house of cards. As soon as these borrowers can't take out any more debt to solve their issues, that could spell serious trouble for this BDC. However, let's now look at the evidence that would suggest that Prospect isn't in such a dire situation. First, I think people should know that Prospect Capital's CEO, John Barry, is somewhat of a regular target. People love to criticize him because despite Prospect Capital not being a household name, their CEO is one of the highest paid in the country. According to a Wall Street Journal article many years ago, Barry was getting paid as much as $100 million a year in compensation. That's because this BDC is known for charging much higher expenses than the industry average. So in my opinion, the media likes to paint him as this ultra-greedy CEO, and they enjoy finding whatever they can to paint his company negatively. The company put out a press release defending themselves after the article went up, saying that they have no issues with obtaining capital and their use of PIK is continuing to be effective for their overall strategy. They also published this presentation on their website, highlighting some of their strengths. But what I think is one of the biggest positives going for Prospect is that they've always had a significantly higher insider ownership percentage. This slide in their recent investor presentation shows that board members own 26.6% of all outstanding shares of this company. That's way higher than average, and John Barry has a significant amount of his own personal wealth tied to Prospect Capital. It's obviously not a guarantee that there isn't anything suspicious going on, but it's just not in his best personal interest to take significant risks or gamble with his company. Furthermore, there haven't been any insiders selling shares in the past 12 months, which is encouraging. But the biggest issue for this stock is the constant decline in their share price. Since their IPO in 2004, their stock has declined about 68% in share price. PSEC is still down about 7% in share price since this article came out. Their stock is down almost 20% for the year and down 26% in share price over the last 5 years. Of course, that doesn't include the dividends, so if we look at the total return over the past 5 years, we can see it's delivered a total return of 32.52%. That comes out to an average annual return of 5.79%. That's not great considering other BDCs like Ares Capital have done way better over the same 5-year period. Normally, buying a BDC at a share price lower than its NAV per share is an ideal move, and PSEC is significantly undervalued by this standard BDC metric. But the bizarre thing is, they've been largely undervalued for a decade. So even though it's been on sale by a large amount for a long time, it's still been a mediocre investment. From a dividend perspective, Prospect has gone through several dividend cuts throughout their history, although their current dividend of 6 cents per share has been steady since 2017. But in the end, the issues revolving around this BDC are concerning, but it's not a guarantee things are going to collapse for this company. Your initial thought might be that this looks like some kind of hit piece, like along the lines of what we've been seeing against Medical Properties Trust. But this article is a lot more sophisticated than what we've been seeing from Viceroy and other short sellers. They interviewed a handful of former employees and other people connected to this company, which you don't normally see in these reports. But again, there is a chance they could find a way out, especially with the anticipation of interest rates being cut in September. I'd imagine this is going to significantly benefit this company, probably more than most BDCs. I think it'll really be the relief this company needs, but we'll have to see if it's going to be too little too late for them. But even if they do survive without a major dividend cut, their performance history is enough to keep me away from investing in their stock. But with that being said, that's going to conclude today's video. If you'd like to connect and also see what's inside my own personal dividend portfolio, then feel free to check me out over on our Patreon, where you'll receive updates and be able to talk to me and other higher yielding dividend and income investors. But with that being said, thank you all so much for watching today's video, and until next time, take care.